Hey, you, friend with the AirPods in listening. Guess what? You can watch this episode in video now. I know. All you have to do is head over to our YouTube channel, and there's a link in the show notes. So go ahead and click that. You can see all the faces that producer Steph and I make when we're about to say the same thing at the exact same time. It's pretty cool. Check us out.
Edit audio.
Hello, everyone. I'm Robin Hopkins, and this is Well Adjusting, where I talk to people about life stuff, but not in an NPR way. It's more like we're at the bar, having cocktails, getting into your business sort of way.
It's giving drunk NPR.
Oh, and producer Steph is here too.
Hello.
Hello, friends. Robin here. Now, okay, many of you may know that producer Steph is originally from Canada. Steph, say something Canadian.
Justin Bieber, Caesars, Out and About. I love Canada. Oh, Canada, maple syrup.
About maple syrup. Anywho, Steph relocated to New York City, and now she is continuously perplexed by people talking, and when I say people, I mean me, about 401ks, mutual funds, high yield savings accounts. I could go on and on and on. But, of course, this got us thinking, because what do we do, Steph, when life happens? What do?
We make content.
That is correct. And let me tell you something. Nobody ever had to ask me twice to talk about finances and money because I'm a bit of a loser. So, Steph,
Huge.
What do you have to say?
Let's talk about money.
Money. All right. Today we chat, well, the basics of finances. Now, folks, before we get into this, I do have to say one thing. I am not, nor have I ever been, a financial advisor or an accountant. I'm just a dork with some financial trauma in my history who frigging loves to talk about money. So the goal here today is to give just a bit of an overview on some of the confusing financial terms and to talk about a way of approaching finances so that, the goal is that your wealth grows and you don't always feel like you're behind the eight ball and you're digging out a credit card debt. But I am going to say, once you want to get started, first thing you're going to do is get educated. Once you get educated, get an accountant, get a financial advisor, get a person to help you, because I am a firm believer in getting experts who can help you make the most of however much money you actually got. It doesn't matter if it's $5 or $5,000. Don't you want to make 10% on that? I do. All right, so we're going to get right into this. Let's just go over some stuff in like a general way so that we all have a context about what we're talking about. But do you want me to just run through some things, or do you want to start with the ones you have questions about? How do you want to do this, Steph?
Well, what's interesting, and I feel like this is the interesting thing about all Well Adjusting episodes, is that as I was thinking, I was trying to write down all of the things I had questions about U.S. finances. And then I realized some of these are actually questions I just have in general that I have not been paying attention to. So give me
an example of that, because I want to know what you mean by that.
Well, so I just got approved for a U.S. credit card. So I'm okay, right. Amazing. I look like a baby on paper, even though I'm 34 years old and have had a credit card for years and years and years and have built credit. In Canada, none of that credit counts in the States. So I got a credit card maybe a year ago. But I keep trying to up my credit score here, which does work a little bit differently than it does in Canada. But I realized I got this message from my bank that's your credit card statement is due on the 21st. I got that message 10 days before it was actually due. And it says you have $500 on your credit card. Minimum you owe is $40. But then if I log into my bank, I can see that I actually have spent $1,500. So do I pay off the whole credit card, $1,500? Do I pay off the $500, yes, which was what it was on the statement, or do I pay the $40? What's better for my credit?
Well, so what's so interesting is that we're already at a point where it's there's the rule, and then there's the thing that's how you approach it, right? First question right out of the gate. So the rule is you do whatever the fuck you want to, right? You could pay your minimum. You pay your minimum, you're going to be paying it forever. That $10 thing you bought, and then that other $10 thing you bought, you're ultimately going to pay $28 or $30 per, because you paid so much interest because your interest rates are so high. So it's you could do whatever you want to do. But what I am going to tell you to do is to pay off. Yeah, no, don't pay minimums. That's just a recipe. That gives me, I already have anxiety. But you should, in theory, be paying off however much you put on the credit card that month. We have this idea that you put something on a credit card and they're just holding it for you. Sure, they're holding it for you at 20% or 19% or whatever, percentage your card is at. Some of these cards, especially if you have new credit like you, Steph, your rates might be, and I'm curious, I might make you look it up, might be as high as 25, 26%. That's an insane amount of money for someone to just hold something like you bought a CD and it costs, nobody buys CDs. How old am I?
I don't like, how old are you?
You bought coffee for you and your friends and you just decided to let it ride because you didn't have enough disposable income this month. That cup of coffee, you're going to pay for it 4 times. Why? Don't do that. Pay everything off that if you can each month.
Yeah. I mean, caveat, I never have ever spent money on a credit card that I do not have in my bank account. Like, I don't use my credit card as like a holding place, but I guess I'm confused because I can see, I just logged in because I'm a producer. So I can see right now I have $1,800 that I've spent on my credit cards of charges. Okay. So I'm in debt $1,800 basically. But the bill I got from my last statement was $513. So am I supposed to pay $513 or am I supposed to pay $1,800? And is one of those worse for my credit going up?
Well, okay, there's a couple of questions. This $1,800, was some of it spent last month and it wasn't fully paid off?
No, I've never not paid off my credit card.
Okay, great.
I spent it since then.
Because if you don't, it gets carried over and then they're still putting interest on that, right? So like the $500 might be just what you spent this month and the $1,800 could be what is in your next month. So for me, in order to not get charged interest, I pay the full amount that is on the statement for the month. Because this is what's so weird about it is your billing cycle, like I'm all about the poor Mary, the number of times in this household that I'll be like, listen, we got to hold until the next billing cycle. Don't buy that now. Wait till and she's always like, are we in the new billing cycle? Like mine ends on like the 3rd and then it's not due till the 20th. I pay on the 15th. Okay. So that means that between the 3rd and when I pay, I'm charging for into the new month. So let's say I charged $4,000 last month and that's what's due on the 15th. Mm-hmm. Okay. But between the 3rd, if I tend to charge $4,000 a month, I'm going to have another 2 that I spent because I'm already half a month in. So my balance is going to be $6,000. But Robin Hopkins goes in and pays the amount of the statement from last month, last billing cycle, which was $4,000. If you pay that full amount of the statement, you will not have, I could see your eyes are already panicking.
Well, I guess I'm just like the panic is that so I would feel more comfortable paying the $1,800, even though that's not from the last statement. So my statement that's due is only $500. But my brain is like, pay off the 18 because then your next statement will be less.
So what's missing here is what's your budget, because you should be only spending each month how much your budget is. So one month you spent $500 and one month you've spent $1,300 so far. Is the $1,300 over budget? If going back to my example, my budget is $4,000, right, per month on the credit card. That's what I want to keep it at. So if I get to $6,000 by the time I pay it halfway, I'm on budget for the new month. Right. Like you can check in midway. I use the 15th. It's why I put my credit card payment on the 15th and my billing cycle to be done at the end of the month. When I go to pay it, I am not only paying my last month entirely, but it's a halfway point of if we need to slow our roll. So when I do the bills, that's when I announce to Mary, hey, everybody relax on the credit card because we're already over budget at the halfway point. Does that make sense?
Yes.
It's a check-in
I have
point.
One follow-up.
Okay.
My budget is more than my credit limit.
Listen, I'll tell you that's a problem you don't need to worry about because in 5 seconds, when you start charging this amount and then paying it off in full, they'll be like, ooh, she's really handling this. Within 6 months, they will, without you even asking, increase your credit limit. So for now, your whole goal as a new credit card user and as a person who's trying to establish credit, I think this is a really important distinction, is the best thing you can do to increase your credit limit is to make small purchases, pay them off every month, and use the card frequently. So your goal right now is to just dinners, lunches, things like that. Use it, pay it off. Use it, pay it off.
I mean, I really did some screw ups. Like when I moved to the United States, there was so much going on. It was such a hard move. And I let some things slip. And I think it took me like a year and a half, 2 years to realize, oh shit, you like let things slip. And some of those things were like finance related. Like
what did you do? Did you start spending money? What did you do?
Not so much spending too much money, but I was confused about moving money between the countries and if I would need, because it's actually like really difficult for me to take money from Canada and move it to the States without physically being in Canada. And for a large amount of time when I first moved here, I physically could not go back to Canada because it would have fucked over my visa. So my visa is in my immigration status, not my credit card visa.
Right.
So it was very difficult. And I also was really scared because at the time I was still paying a lot of Canadian bills. So I needed like a large lump sum of money in my Canadian account. So I basically just kept all my money in Canada and then started net new in the States, which was probably not the smartest thing that I did. But then I started having American bills too. And I got really freaked out about my money situation. I paused all of I was making bi-weekly payments to savings. I paused all of that because I was like, I don't know how much money I can pay myself in the States, blah, blah, blah. That was error number 1. Error number 2 was that I was spending on my Canadian credit card because I wasn't approved for a U.S. credit card yet. And it took me like 6 months to get a U.S. bank. So I was spending all this money on my Canadian credit card. And then I started making money in the States and I stopped looking at my Canadian bank account and I didn't pay off my credit card. So That's
okay though. But have you handled it now?
No, but I will. I mean, part of doing this episode was I looked at that credit card, which is hilarious because I run a business. So I am constantly looking at, I have like 15 bank accounts for the business that I'm constantly moving money between. But I think that's honestly part of the problem. I spent so much energy and focus on protecting the company. I didn't protect myself.
Were you getting like tons of late fees and stuff?
Probably, but I wasn't getting them because I wasn't in Canada.
But have you looked yet and to see?
I'm looking right now. Oh my God, the live reveal.
I'm so nervous. A live reveal.
Da, 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 da. Oh, my interest charge is $99.
Oh my God, Steph. We're talking about $100. You and I would spend that on 4 cocktails like on a Saturday. $100. Yeah, you can't beat yourself up about that.
$100 a month.
Oh, a month? Oh, shit.
So I've been paying $100. I mean, they're around $100 a month of interest for probably a year.
Okay, that's less great. But now you know. And then this is like, I think this is the whole thing is like, now you just have to, what's your plan to get out of it?
I mean,
like,
I have to pay that right now.
Do we have to pause the recording so you can pay it?
We have to pause the recording. I must pay my credit card off. I'm freaking out.
Pay your credit card off, please.
Well, there goes my savings.
So here we had to pause for a few minutes because Steph freaked out. She wasn't able to transfer money between her Canada bank and her U.S. bank, and she has to pay the bill. But don't worry, she's written a sticky down. She's going to handle this after the show.
Okay, but I do have another question while we're on credit cards.
Okay.
So I have this bill, thanks to your financial doc that I made into a spreadsheet.
You did make it into a spreadsheet.
Set all my payments to be due after the 15th so that I look at the 1st and the 15th, and then they're due on the 20th just in case I fuck up or I'm sick or something. I have like some buffer time. So my credit card bill is due on the 21st.
Okay.
Should I pay it now? Should I pay it on the 15th? Should I pay it on the 21st? Does it matter, or do I just have to pay it before the 21st?
It does not matter. You just have to pay the full statement balance and any previous debt, if there were previous debt. That has to be paid by to stop getting interest by the due date, which is the 21st.
Okay. And if I had debt on my credit card, where would it show up?
As a balance. So you would see previous balance, then you would see current month spending, then you would see interest, then you would see any late fees, and then you would see a total, like the total on your account, and then they would give you a minimum. So if you did have a balance that you carried over and you don't want to be paying any interest, you want to pay that balance plus the statement. Now, that's not maybe doable for everybody. So like, here's an example, right? I like to pre-save for everything. So if we're going to go on a vacation, I like to pre-save for it. So if I have a budget of $6,000, the vacation's in August, I want to have $6,000 saved before August. I want it all paid off before we go on vacation. But that is not always possible. So let's say we want to go on this cruise. I hate cruises, but we want to go on one for some weird reason. And it's $6,000 and I only have $3,000 pre-saved. I charge it and I have $3,000. I will then, for me, set a deadline of I want this paid off in 6 months. And so then I will say, okay, I had a $3,000 balance. In order to pay it off in 6 months, that's how much do I have to pay? $500 per month. So then each month I will pay the statement balance, everything that I spent, plus $500. Now, maybe it's $500 and some change because I'm going to want to also try to pay off the interest, or you're just going to go into the last month, you might have to pay an extra $250 or $300 for the interest. But like that is how I would attack something if I had to put it on a card, and I would not add anything. I would not add anything else to that card that I could not pay in full. Does that make sense?
Yeah.
So let's just go back to my magic situation of my budget's $4,000, right? And I put the cruise on and I owe $3,000, and now like $4,500 is what I would be due each month. But the question to you personally is, can you pay $4,500? For me, I would probably not go on the cruise if I couldn't have it paid off in a timely fashion. Because if you get past 6 months, you have to ask yourself this question: what's the likelihood that another thing is going to come up that you're going to want to put on and let it ride? Pretty high. So if it's beyond 6 months, that if you can't add that to your budget, you either have to do one of two things. You either have to drop your budget down to $3,500 for the month so that I can pay the $4,000, which includes my $500 from the cruise, or I have to have, because if your costs are hard costs, like on my credit card are groceries, utilities, like phones, those are hard costs. They're not changing each month. So $4,000 is my target and I can't drop that down. Then I have to be able to pay $4,500. So if I can't come up with that, then you got to ask yourself, should you be going on this cruise? Mm-hmm. Probably not. But I think for some of our younger listeners, this is going to come up like, forget the stupid cruise. You're in a wedding party. And like, I don't know what the fuck has happened with bridal like
so
party. Like, why is everything like a 4-day trip now? And then your dress and then this, like, it seems like everybody's got to come up with $2,000, $2,500, and you might have to let something ride. I'm just saying, try to get paid off in 6 months.
Yeah.
Because you're going to have 7 weddings in your 20s.
Yeah. And you don't want to look back in 2 years and realize you've been paying $100 a month to a credit card.
Poor Steph. We're going to need a therapy session after.
On Well Adjusting, there's always talk about how life can get overwhelming, whether it's finding a new apartment or just setting boundaries. That feeling is real when you're caring for an aging parent, too. Care.com knows it's a big shift when the person who raised you now needs your help. But you don't have to do it alone. With Care.com, you can find background-checked caregivers for anything from companionship to dementia care. You can even read reviews from other families and schedule tours of senior living communities. If you're not sure what's best, Senior Care Advisors can help you make a plan. For a limited time, use the code POD20 for 20% off your initial Care.com subscription. That's POD20, all one word, good for 20% off. Start your senior care search today. When it's not you, it's Care.com.
Hey friend, I'm just jumping in here to say that we've got a new way to get in touch with us. If you want to leave us some feedback, hopefully good, or suggest an episode topic or ask a question, all you have to do is go to sayhi.chat/welladjusting. The link's in the show notes, but I'll say it one more time. sayhi.chat/welladjusting. You could leave us a voice memo and we might just use it on air. And if you happen to be enjoying this episode, why not go ahead and subscribe to the podcast or rate and review us? You won't regret it, folks.
Security program on spreadsheets, new regulations piling up, and audit dread? It's time for Vanta. Vanta automates security and compliance, brings evidence into one place, and cuts audit prep by 82%. Less manual work, clearer visibility, faster deals, zero chaos. Call it compliance or call it compliance. Get it? Join the 15,000 companies using Vanta to prove trust. Go to vanta.com/calm.
Okay, I have so many more questions. So
okay, keep it moving. We'll get off credit cards.
Move this along. What the fuck is a 401k? What is a Roth IRA? What are all of these things that I only know the names of because you say them, and also they're in the New York Times crosswords that I do every month?
Okay, so we'll go through them really quickly, but this is the part where I'm going to say to you, dear listener, and you, dear Steph, like, you got to get educated on this shit. You just need to know, and then you need to get a person. So a 401k is generally, it's a retirement savings vehicle, and it started in the workplace, and it's often employment backed, and there's government limits as to how much you can put in. This is the part where it gets so confusing. And I'm going to try to say this in the most basic way. And again, please go out and there's got to be 100,000 YouTubes of somebody who's like a person who will explain all this to you. But it defers your taxes. So if you made $100,000 in income, that's your salary, and you get, let's say you're in a 24% tax bracket, however much you put into your 401k, up to whatever the government says you can put in, is not taxed. Not when you put it into your 401k. So the idea is that you are reducing your tax expenditures when you put it in. So if I put $20,000 in my 401k over the course of the year, I should only pay taxes on $80,000. Now with a 401k, wow, you will pay the taxes when you take it out, when you retire. But it's meant for retirement. There's only limited ways in which you can touch it. But if you're young, motherfucking sign up for the 401k. If you only make $50,000 a year and you put in 6% into your 401k, you will not see much of a difference because of the reduction in taxes. And most employers will match up to a percentage. So like if you put in 6%, oftentimes they'll match up to like half of that, up to 6%. So they'll give you an additional 3%. Once you hit a certain age, you can save more. It's like almost like panic savings. Like once you hit 50, you can put more in. So that's a 401k. I already saw you had a question. Go.
Okay. Does that go to like a government account that you can withdraw then from, like, does the American government pay for retirement?
It goes to whoever your company chooses. Like Merrill Lynch, Charles Schwab, Voya, Vanguard. Your company will pick.
And what are they doing with it?
You choose. You can put it in a target age-based one, which is what I do. If you're not a person who has a lot of information about the market, or you don't have somebody to balance your 401k, you can say target date retirement 2047 based on your age, and they will be more risky when you're young and start getting less risky as you get closer to retirement. So I'm a big fan of the target base.
So this is where this gets confusing for me because I'm Canadian. So like we have the equivalent of a 401k in Canada, but it goes to a government account.
That's Social Security in the United States, which you may or may not get when you retire.
Right.
Womp womp.
So why would you then trust like a Merrill Lynch to put your money with instead of like going to your guy Rich, your financial advisor, and being like, here's $10,000? Like, why would you give that $10,000?
Because one, I'm reducing my tax burden at my employer.
So you can't choose to do it privately. You have to do it through a company. Like you can't tell Rich, like, hey, I have this money for my retirement.
No, you cannot. Whatever 401k your company has set up, that's where you invest. And here's the thing. That's not the risk. There's like they set them up with large scale corporations the only risk there is to put money in the market or not. If you're a person that doesn't believe in that, then you're putting money under your mattress, and I'm not for that. So like that's not your risk.
Funny.
Steph. That's not your risk.
No, but this is so funny because it gets at this like core.
I know you're scared of the man.
I'm terrified. I mean, to me, like the idea of putting my money with a large corporation, I'm like, abso-fucking-lutely not. Like that's terrifying to me.
But you're in Chase. That's a large corporation. You're
right,
in
but
a bank.
I guess so. My retirement savings are with a person who I trust, who is my financial advisor, and with
Steph.
The part that's earmarked for retirement is earmarked through the government, so that's still tax free. But
look at my
anyone
face.
can. What?
Your guy or woman or person that you're investing with is investing in another large corporation, Steph.
Oh, yeah, they invest in the stock market, but I have at least some amount of
control
control
through a large
over
corporation. That. Like they are like, so my guy Rich.
I mean, he works independently, but yeah.
He works independently, but he has portfolios with companies that he then uses and invests. That is what a 401k is doing. Oh my God, you're so scared of the man. This is like a new fear unlocked. I never saw this side of you.
Oh, please.
If you're afraid of, they're all doing the same thing.
I agree, but at least the person I talk to, I can be like, I do not want to invest in this, 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 and this. And then he makes sure that my money doesn't go there.
Okay. You can not do a target-based thing. With Schwab, you can decide where you put your money, but it's, I do not want that responsibility. I do a target fund. I don't think I can help with that fear. And by the way, the rest of your money that you invest, you can do that with. But I don't know. Do you want to not take advantage of the tax breaks?
No, that's the question that I have. So in Canada, you still get the tax breaks even if you don't invest with a company. So I am getting the tax breaks because
you are not getting them in the US.
Because it's privatized. So whoever your company decides is the company that you're investing through. Well, then what happens if you switch jobs?
You can roll your 401k over to your new employer plan. You can roll it over to an independent. So I was with Viacom for 20 years and I had a really sizable 401k. I rolled it over to an independent place called Vanguard. And it just now sits there as a rollover IRA. It's making money. It's doing whatever. I can't take it out. All the same rules apply, but it's just there. I could have rolled it over to a IRA rollover account with my money guy if I wanted to. But it has to stay in a retirement account to not be taxed. Because here's the thing. Sometimes people like leave jobs and they look at their 401k like it's a checking account. And they're like, I'm just take that money out. I'm in a tough spot. I need it. Guess what? The government's going to tax you. Not only are they going to take the regular taxes out, there's going to be a 10% early withdrawal fee penalty. And then in addition to that, it's going to be taxed as income. So it's going to be like tax. So if you can avoid it, you never want to touch it until it's retirement age.
And whose responsibility is it to take, like let's say I'm working for a company and I have an IRA through the company and then I quit the job.
You can just leave it there.
It doesn't go anywhere and I can come back in like 40 years and be like, hey, where's my IRA?
Yeah, you have the logins. It's like, let's say it's with Vanguard and my Spotify 401k money was sitting there. I only rolled it over into a new account this year. It was sitting there for 4 years. It's still making money. It's still in the plan. It's just you're not contributing through that employer any longer. But I like not having them in 5 different places.
If your Spotify money is in one like Vanguard and then your Viacom money was in Merrill Lynch, are those connected or they're two separate?
No, they're not connected. They're individual accounts. And I don't.
So it does benefit you to combine them because then you would be investing more
if you're
money.
That type of person. If you don't want 17 logins in 17 places, or God forbid something happens to you, you want your children or your loved ones to be able to find your money. I like it in one joint. I like it, but that's a personal thing. Or if you felt like the plan that your company didn't have target-based stuff or you didn't like it, roll it over. But, you just have to make sure it rolls directly into another IRA.
So, that's, I think, the part that's, interesting to me is because, in Canada, if I die, you could just, look up my name through the government and you'd see how much money is in my retirement account, regardless of where the money was.
We are just
it's all
not
under
that
one
organized.
system. Whereas like in the US, everything's privatized. So it really depends on your individual organization. It puts the onus back on you a lot.
Yes.
Yes.
So and there's a lot of people in this country that want it more privatized. They want it out of the federal government. I'm going to just explain the difference between a 401k and a Roth. And this one, I'm going to be full disclosure that there's different types of Roths and this can get really confusing. So I'm only going to just give the top line of it, which is that a Roth, you pay the taxes now. And then when you take it out, it's tax free. So there's like a whole philosophy that like when you maybe don't make a lot of money, it's a good time to put money in a Roth. But I leave that up to my financial guy, because here's the other thing that's really confusing. Like I just said all that about employment and Roth. There are within your plans, like some 401ks with your employer, you can dedicate, like you can have some that's pre-tax, like that drops your tax burden down. And then you can say, I want to put some in a Roth. And so it's being taxed now. It's like post-tax. So it's like that level is like, go see someone, because there's also really specific limits on how much you can put in a Roth. So I never put any money in a Roth until after I've done my taxes, and my accountant goes, this is how much money you can put in a Roth. And this is how much money you could, because I'm a freelancer. So I have what's called now, I have all my ones from work that are just sitting there. And now I've opened up SEPs, which are a simplified employee pension. So it's just me, and it allows me and my business to contribute on my behalf. So it's like there are so many retirement vehicles that it's just, to me, the simplest one is the 401k. If you are at a job that has a 401k, just sign up. Just sign up. But there's that. And we talked about this at a previous episode. But if you could go to a financial person, and when you're in your 20s, if you were to put just $100 a month into like a Roth or some type of an individual retirement account, if you started in your 20s, $100 a month, I think that the stat was something like by the time you're 50, you'll have like $1 million in there. So just when it comes to retirement, you just do something. Don't get bogged down in the definitions. Find a person. That's I think the most important thing.
Okay. Next question.
I'm scaring you. Go ahead.
No, I mean, this is really good, but it's also like really scary because we're hitting up against a lot of things that I don't want to think about. And I think this is why I brought up my like transition here. Like I was really excited to move here, and then I started like looking at things, and I'm like, you know, I got back in touch with my like financial advisor person just to like get back on my saving train and blah, blah, blah. And he's like, okay, well, what's your like plan for 50 years from now? Bitch, I don't know. I don't even know what I'm doing here. I didn't know I was moving to New York until I moved to New York. Like, I'm not
is it
thinking
safe
that.
to say you have no retirement plan? You're just doing savings. You haven't done any of these, like a SEP.
No. I've maxed out my retirement accounts. I've contributed as much as I can. I'm doing all of the things.
Okay, good. So then you do have a plan. What are you talking about?
Financial. Okay, that's not what I meant about plan. He's like, well, what's your plan? Like, when do you want to retire and where do you want to be? And the where do you want to be? That's so hard. And I'm like, I don't know. And I told him that. And he's like, well, you do kind of have to think about it, because why? And I get this now talking to you. Why would I be contributing to a 401k here if I'm not going to retire in the US? I'm going to get taxed out the asshole taking it out, because I'd be taking it out early. Right?
Well, no, you don't have to take it out early. You could let it sit there until your retirement, and you'll get regular taxed out the ass. You know, you'll only get the extra tax if you don't have to take it out now. So like, I mean, like, look,
but wouldn't I be paying like capital gain taxes in the States every year?
No, there's no taxes on your 401k until you take it out. It sits there. It makes money. It's not reported to your taxes. That's the beauty of it. So that will just sit there until you're ready to go. I think that you need more information on the question from your financial person, because to me, it sounds like what they're saying is like, there's probably a different savings philosophy if you want to retire in Canada versus here. Like if you want to retire here, you need a lot more money. And I think what they're saying to you is like, there's more, like you're not having to build in healthcare. You're not having to build in, there's so many things that you aren't going to have to build in there. And you haven't put into
like,
that
what
system.
A privilege. Why would anyone retire here if that's the choice?
It's
like,
so
wow,
fucking hard.
I didn't even think about that though. And now I'm like, I was just like living here and trying to party in New York for a few years. And now I'm like, oh my God, I have to think about what I want to be doing in 30 years. What if I lose mobility? Like, I can't live in the States then. That's nuts. Okay. Why would I spend an extra $1 million a year?
All right. You've gone a little bit down a rabbit hole with what if I lose mobility? But I do just want to say this, Steph. Like, I'm not kicking the can down the road, but I am saying you don't have to know all the answers today. You don't, but you do have to do something. Like, even if you have $5, it's more than $0. If you talk to these financial people, they will be like with a spreadsheet and a calculator and a piece of paper and a pen and a pencil and a paper clip over their ear. They will be like, but that is $42 more. And I'm not living my life that way. You have to know yourself.
No.
And I don't know where I want to be. I think there's real concerns in the world. Like, are we all going to Europe? Would Europe take us? Like, what would that look like? I can't figure that part out. But what I can do is go, what I know right now is this. And I'm going to save as much as I can, no matter where I am. And then I'll make the best of it. So if you save for here, then you'll probably be better off if you're there. But like they're going to sometimes split hairs. They're going to be like, you'd lose $1,000. And, okay.
I
can't make that decision right now.
You're right. Yeah.
So,
okay. Yeah. I'm panicking about 30 years from now. All I really want to be doing is making sure I'm doing the right things and not getting in trouble, and that I can die happily.
Well, the second part, I mean, TBD, right? But the first part is like, I look at it like live and learn, right? Every year I prepare for my taxes, like got this amazing accountant. Every year I learn something new. Like, and I have a document, like I have a preparation for taxes document that's a checklist, and something gets added every year. I learned something new that maybe I could have taken advantage the year before. I try to read what I can, but I also look at it like I'm not going to get it all. Like sometimes if
I'm not even getting the bare minimum. Like, I feel like I've just been birthed out of the vaginal canal that is the United States, and I'm 34 years old, but I'm starting at like first base. I don't know how shit works here, and that fucking sucks. Because like, if I just go north a little bit, I get it.
You are being shot out of a cannon, and when I hear you talk about things in Canada, like, I don't know, everything we do is difficult here. It is. And it's because every state does things differently, but then there's federal, and it's like, it is a quagmire. So I think that's a state of mind issue that you just have to look at it like, I'm open, I'm learning, and look at how much more you've already learned.
I think what I'm getting from this conversation is like, I need to change my mind to be less like, you're starting at base 0 and you don't know anything and you're a big dum-dum.
No.
To what an interesting place I'm living in, where everything is interesting and I'm learning. And I also need to accept that a lot of the onus of learning things and being responsible for things here is actually put on the individual. Like, I think that's something that I didn't know about health insurance here, or investments here, or retirement here, or credit limits here. Like, it really is up to me. So that pressure I'm feeling is like validated to some degree. You know?
Yeah. No, it's not you. It's us. And, if you look at this, like, let's come out of the lens of all of our privilege, right? We're talking about having money. And so imagine like you're below the poverty line. You're not putting into a retirement account. You are counting on Social Security, and you're counting on your insurance being paid, and then you're hoping you'll get by. And my concern is there's a growing movement of like, privatize more, like fuck the entitlement of Social Security and like put it into the market. And then like everybody, it's like, can you imagine what that will do to people in poverty? Like, so it's like, it's a bad system we have. It's not you. That's a very long way of saying it is not you. All you can do is like shore it up.
Mm-hmm. So, Robin, I did, because we're recording this episode, look at my finances. And before we were recording this episode, we recorded another episode about finances, which you can go listen to with Sylvie. And I started using that document that we created. And it was really that document that made me realize, oh my God, I'm not saving anymore. I totally forgot that I had not been saving. And so I got back in touch with the person that does my investments for me. And I was like, I just like really need to get back on this horse. And the truth is, I don't know how much I can invest anymore. Like I knew what I could then, but my cost of living is different. He was like, you can give me whatever you can afford. So you can give it to me monthly. You can give it to me weekly, bi-weekly. Obviously, the more small, well, not obvious. This was not obvious to me. He was like, the more payments you can give me, the better, because I can invest them at different times.
Yes. Yep.
I guess, do you have any sort of like ways that I could think about figuring out how much I can invest and when?
I do.
Can you tell me them?
I can. So your significant other moved in with you, and you were paying the full rent. Now you are not paying the full rent. I already know you can pay that full rent. So that means to me, unless you were in a significant amount of debt that you're catching up from, you have that difference in rent that you can now invest. That's one way to look at it. Anytime there is a change in your circumstances for the positive, you were already living with what you made before. So I like to take that new money, whatever it is, and at least half I put away. If you can't do that, let's say your circumstances stink. You were like in debt, whatever. Obviously, we've had some episodes, go back to the first episode with Aileen where we talk about getting out of debt. We also spoke to Ruby about getting out of debt. And both of those episodes are going to be linked in the show notes. So you're going to want to go back and listen to them if you haven't already. And then once you are out of debt, whatever money you were paying towards your credit cards now can be invested. And let's just say you're like I do this thing. There's this thing called Acorns, which I've talked about before. Like, why the fuck is Acorns not sponsoring us? Maybe because I just said their name and then the word fuck. But I just realized, and talk about beating yourself up. I was like, oh, they have this thing called Acorns Early for kids. And I was like, oh, fuck. I was like, my family did a commercial and my kids made like $1,500. So I've had that like I've had $1,400 because I gave them each $100. I was like, guys,
wow,
here's $100.
generous.
And they were like, what? So they each had their own savings account with that $1,400. It was in there for like 4 years and made how much money? Zero, like a penny or two, because it was in just a general savings account. So I moved it into Acorns last March. I kept, and by the way, I also throw, like, if they get money from a family member or something, I let them have half. I put the other half away. So, I don't know, they had a couple grand, right? And I want that to be something for them when they come out of college. Put it in Acorns last March, and they've each made over $250 in a year. So, because now it's in the market versus in a savings account. But circling back to your initial question, I was like, I'd like to do a little more for them. I put $50 a month into my Acorns because it's like $50. I look at it and I go, how many times do I go out and spend way more than $50 on a margarita? Like, because it's not one, I have a couple. Lots. One could argue maybe a little too much. So in those, I could certainly put $50 into Acorns for me and Mary. So I took that same philosophy and I was like, okay, I've been doing $50. I don't really notice that. Could I do $25 for each of my kids once a month? So now I put $100 into Acorn, 25 goes to each of the kids, 50 goes to me, and they're making money. So by the time that $2,200 that's in there, $2,500 that's in there now, by the time they come out of college at 21, for one kid, it's going to be $7,000. For the other, it's going to be like $8,000 because they're different ages.
Do you get taxed on that when you pull it out?
Yes. And I do pay capital gains, but who gives a shit? They made $250. I'm paid $11 in capital gains. Like, and that just goes into my tax returns.
I think there's a fear for me of giving this money to a person and then not being able to have access to it because I feel unsure of my current living circumstances.
But let me ask you this question. Could you give them $100 a month?
I really don't know. I feel like I have to figure that out. I think so. I mean, I assume so.
I feel like why not? Well, let me just say it like this. I was like, last year had been a better year for me. I was like, what could I do? I know my expenses. I know how much generally, how tight things are, how much we pre-save. It's like a feeling. I was like, I think I could do $400. I was doing $400 a month. The second at the end of the year, when my Permalance job went away, I emailed and said, stop it. And they stopped it. And if I need to get that money out, I will pay taxes on it, but I can get that money. But it's been making money. It's been making 10% for a year. I'm not going to lose money. And I would argue you would never have saved that money in the first place.
Yeah. I think I've been pulling a Steph and like going too hard in the paint. Like I was like, okay, I got to invest this. And so I was like, I'm going to put $1,000 aside and from my checkings, like automatically transferring from my checkings to my savings every month. But that's too big to start from. I think I'm maybe 1,000.
Yeah, stop it. Stop it.
I think I need to start with like 100 a week and like keep doing that, get in the rhythm. And then maybe after 3 months, I can reassess.
Yeah. Anytime you get a raise, you get a big client, something changes, you get more money, take it up to $1.25. But you have to find your rhythm and your balance. You've got to find it. And and what's interesting, and we've talked a lot about terms in this, but what we haven't talked about, and I can't believe you and I've never had like a more in-depth conversation. We've talked like, oh, money trauma, but there's so much fear in the way that you are looking at this stuff. Like there is so much fear. And I understand that because that's me too. But your fear is like, it's a different fear. Like you got the fear of the man, you got a fear of like, I can't get to it. And I guess I want some stop technique. I want something around this. And then I want you to bring in some logic in those moments. Well, can I get to it? How long would it take? Ask those questions. How long would it take for me to get to it? What would be the tax implications? Would I have saved it if I didn't give it to you?
I mean, the part of me that gets emotional is like right then, because it's like, I know myself and I know that I have like so much fear around like becoming houseless or like not being okay and not having people to rely on. And so I have so many different like pockets that I've like stored money in. And the distrust of the man and the distrust of everything like stems from that. Because that's me not feeling like I have access to money in case I think I'm going to need it. And that is like, first of all, I have so many years of evidence that like I'm fine. But part of that reinforces the problem because I'm like, okay, well, I'm fine because I have those pockets stashed away, And that's like, I'm forever going to have to work on that. But that is the part of this that like, the fear of me not knowing where I'm going to retire. Like, I don't fucking need to decide that right now. I know that logically. But like, I do feel like I'm like, okay, well, if I put money in the States and then I move to Canada, what if I can't access the money in the States? And that hits like a core thing of me that is like, well, what if I'm not okay and I need the money?
Yeah. But I think...
So you're going to just tell me I'm okay?
Well, you are okay, though, because I think that the thing that you said it makes you even more nervous because you are thinking all of my, my behaviors are what kept me okay. And that fuels it. I would challenge that to say that you are doing the things to keep yourself safe. And because you're doing that, like you're getting a credit card, you're worrying about your credit scores. Like you could, if one had to, like you're going to have a $25,000 credit limit in 5 seconds. That would be your emergency fund if you had to, if you couldn't get to money. You have a backup and a backup and a backup. And because you did the work, it's just the last part I want you to reframe. Because you did the work, you can calm down. And that should be part of your sticky note system of, because I did the work doesn't mean that I should be more scared. Because I did the work, I can calm down. You have multiple safety nets that I see.
Oh, so many. We didn't even touch on the money in the mattress. I mean, I'll end with this anecdote that is that one of my friends, I broke my leg really badly and I had some friends take care of me. And as they were taking care of me, occasionally they needed cash. They're going to do my laundry. They needed actual physical bills. I'm like, oh, yeah, go into like this book on this shelf and grab there should be like $100 in there. And my friend Libby was like, Steph, this is unreasonable. I love you, but it's unreasonable. And she raised a very good point that was like, what happens if your house is on fire? Like, the money is just all gone. And I was like, well, yeah, but the house is on fire and I'm dead. So, like, who cares? And she's like, what if you're not home? I've never thought about that. Anyways, she bought me a safe because I was like, I'm not taking the money out. Like, I need money at home. What if all the banks close? And, like, I am like World War, this is all the things are happening in my mind. So I'm like, I need money at home. And she's like, okay, well, if you're going to keep money at home, at least put it in like a fireproof safe. And so that is my 2025 goal, is to find all of the money I've hidden in my apartment.
Oh my God.
And put it in a fireproof safe.
Okay, I like that goal for you. I mean, like, look, I have just different money trauma than you. Mine is like, it'll never be enough. I don't have any issues with the man. Like, it might crash, but I don't know.
You're not hoarding your money.
Well, because at that point, everybody's poor except for probably 5 people, and there's nothing I can do. Like, that's like the collapse in 1929 or whatever. I hope there's things in place that bail us out, but I can't. That is such a global fear that I can't even get on board with that. But I would never negate it. It's real. You feel it. I just want you to take a mantra that is, I have backstops in place. Like, let's try to get the money into a safe and find your money. Like, my dad used to do that. He would save it in the curtains, but my dad was like trying to avoid taxes.
That's a genius place to hide money.
Well, it's not now, not that I just said it. But the point is, like, I just want you to feel more comfortable and more safe and secure and know that I am hearing what you're doing. You're doing enough. Just keep educating yourself. And I do have to say this to the listeners. I want to say, look, I know how hard this is. We actually, this was a recent episode where we talked about this financial planning doc that I had made. And after the recording, we shared it with the guest, Sylvie. And then you, Steph, you redid it in Excel. And I was like, well, hold on. But I tried it, and I was very uncomfortable for like 2 months when I was paying my bills. And I kept both of them. I was running both of the documents in case I didn't like yours. But my point is that I had a thought, because I bumped into Sylvie on the street from that episode. I bumped into her on the street while I was taking a walk. And I could tell she was like, oh, shit, I haven't started the doc yet. And I thought how overwhelming it was for me to just switch docs. I wanted Sylvie to know. I want you to know. I want anyone who's just starting out. Like, whatever these docs are that we're providing, they have a lot of information. Start where you start. If you just get your bank accounts in there, that's a good place to start. And if over time you're adding to it and making it your own, if Steph starts with $100 a week or even $50 a week, you just start where you start. It is overwhelming. It is scary. But I keep saying it, $5 is better than no dollars.
Yeah. And you can fall off the horse and get back on.
That's right. So, okay. So I kind of started to go into takeaways, but I want to say this again. I am not accredited. I have never taken an accounting course. Get help. Find your financial advisors. Look up all the stuff, the questions that you have. Don't ignore your finances. If you are in debt, pretending that you are not in debt, and it's not happening, it's only going to get worse. It just is.
Not opening your Canadian bank account for a year is not
to the tune of $100 a month worse. $1,200 extra. That's a fucking hard lesson. See if you can reframe your thinking about money and find the fun, find the positives in it. Maybe feeling financially secure allows you to feel safe, or maybe saving and being smart with your choices allows more travel. Find the fun, find the incentives. I'm all the time doing that with my kids. What are your takeaways, Steph?
Yeah, I love that. Well, my one takeaway is that I have to look at my Canadian finances again and pay off my debt because I'm in debt and I didn't even know it because I wasn't looking at it, and that's silly. My second takeaway is that I can be a little nicer to myself about not knowing things here, and that I also don't have to be hard on myself for not putting savings away. I can just start that again, and I can start smaller than $1,000.
You sure can.
And then I think my other takeaway is that I should look around my apartment for all of the money that I fit in. But yeah, I guess I want to know, like, I feel like I put myself in this like weird position to get advice from Robin and talk about how bad I've been with my money and how great I'm going to be. And yeah, I guess I just want to know if people found it useful and, you know, what we should talk about next. If there's other money things that we didn't talk about, if this raised any questions for you, let us know.
Yeah, we definitely want to hear from you. And we want to know, like, I don't know, are you more of a Steph with the panic? Are you more of a Robin with the panic? Or do you have a totally different panic that we don't even know about? Reach out to us.
Our email is hello@editaud.io. So that's hello@editaud.io.
Woo!
Or you can hit Robin up on all the socials.
Real Rob Hops.
Bye. Time to pay my credit card.
Well Adjusting is an Edit Audio original series. It's exec produced by Steph Colburn and Robin Hopkins. Our producer and editor is Maria Passingham, and our production manager is Kathleen Speckert. Thank you to the entire Edit Audio team and to you for listening. Oh, hey, before you take out those AirPods, this show is just for entertainment. If you are in need of help, please, please, please reach out to a professional. Go ahead and get that help. You deserve it.